Hello everyone, and welcome back. This week as well, we'll bring you our financial market outlook. How will the market move this week? Let's get started. This week's theme is the end of the carry trade. On the surface, the markets appear calm. However, beneath that calm exterior, significant distortions and accumulated energy continue to build. This prediction is based on statistical analysis of exchange rates, interest rates, and financial products from 17 other markets over the past 200 weeks. Let's begin by looking at this week's convergence point, the profit-taking target level. USD JPY is 153 yen and 48 sen. EUR JPY is 179 yen and 44 sen. EU DJPY is 100 yen and 58 sen. The Nikkei 225 is 48,758 yen. The Dow Jones is $47,243. 10-year JGB yield is 1.93%. Gold is $4,135. We expect the market to gravitate toward this zone. Market recap last week. The contradictory magma building in markets, puzzling movements in interest rates and FX. At the end of last week, all three major U.S. stock indices closed lower. Following this trend, the Japanese equity market is also likely to start the week on a weaker note. As mentioned last week, a major contradiction currently exists in financial markets. Despite worsening economic conditions, stock prices remain elevated, supported solely by expectations of lower interest rates. This contradiction has been accumulating in the market like magma beneath the surface. The United States has already implemented a 0.25% interest rate cut. Meanwhile, the Bank of Japan is widely expected to raise rates by 0.25% at its policy meeting on December 19. This would result in a 0.5% narrowing of the interest rate differential between Japan and the US. Despite this, the dollar-yen exchange rate has not moved toward yen appreciation. In addition, with the release of U.S. employment data for October and November scheduled for December 16, the market is enveloped in a highly delicate atmosphere. The chain reaction of carry trade unwinding, how yen strength impacts Japanese stocks. If the interest rate differential narrows following the BOJ meeting on December 19, there is a strong possibility of unwinding of carry trades that have exploited the Japan-US interest rate gap. This could trigger a chain reaction of stock price declines, risk-off sentiment, yen appreciation. A stronger yen would dampen inflation expectations in Japan by lowering import prices. At the same time, expectations for stock price gains driven by inflation would also fade. Japanese equities are heavily influenced by the behavior of foreign investors engaged in carry trades. Therefore, the impact of a narrowing interest rate gap cannot be ignored. The true nature of inflation cost push inflation, the limits of monetary policy, structural issues behind rising rice prices. The current inflation environment originates from the Ukraine war and represents cost-push inflation. This type of inflation is driven by supply shortages, and monetary policy is fundamentally neutral toward it. Adjusting interest rates does not directly suppress cost-push inflation. Although the Bank of Japan has raised rates twice from zero in the past, the impact on exchange rates was limited, and these measures failed to curb rising import prices. As a result, monetary policy has reached an impasse in addressing cost-push inflation. This same structure applies to the surge in rice prices in Japan. Rising interest rates or distributing rice coupons will not bring prices down. What is truly needed is increased product in. Ideally, Japan should increase production of high-quality, affordable rice, and expand overseas demand by exporting surplus supplies. Nevertheless, it is difficult to understand why policymakers continue to cling to short-term price support rather than shifting toward increased production. One cannot help but speculate whether this approach is aimed at quickly filling the financial hole left by last year's 2 trillion yen loss at Norinchukin Bank. Returning to the broader market discussion, the reason behind the U.S. rate cut lies in the prioritization of deteriorating labor conditions over inflation concerns. In effect, the Federal Reserve has acknowledged an economic slowdown. Combined with the unwinding of carry trades, we believe that both U.S. and Japanese equity markets are likely to enter a correction phase from here. Key event this week: if the BOJ holds rates steady. This week is packed with critical events. December 16th U.S. Employment Report, December 19th Bank of Japan Policy Decision, U.S. Major SQ Special Quotation. If the Bank of Japan were to unexpectedly refrain from raising rates, the currency market could swing sharply toward dollar strength and yen weakness. In that case, close attention should be paid to the possibility of currency intervention, potentially even coordinated Japan and the U.S. intervention. Which way will the magma erupt? This week represents a critical juncture, as the market attempts to determine which direction the accumulated magma will erupt. Please note that the above predictions are based solely on a stable convergence model derived from statistical analysis. And we accept no responsibility for the results of any investments made based on these predictions. We will continue to provide forecasts based on data and statistics. I look forward to seeing you again. That concludes this week's outlook for the financial markets. Thank you for watching.